All right, let's talk about something that sounds super technical, maybe even a little boring, but it's a financial trick being used by hundreds of companies that can have huge consequences for investors like us. It's called a reverse stock split, and while it might help a company and its backers, it often leaves everyday investors holding the bag.
So to kick this off, let's start with a question that sounds, well, completely impossible. How on earth can a stock lose so much value that its price falls by a factor of 1, with 15 zeros after it, in just 3 years?
Okay, so to unpack that crazy number, we've got to look at the company behind it, an aspiring electric vehicle maker called Bollinger Innovations. And believe me, this story is a wild one. So you look at their books, right? And Bollinger is, well, they're struggling, to put it mildly. We're talking billions of dollars in losses, and they've barely sold any vehicles. So that begs the real question. How in the world is a company like this still trading on a major exchange like Nasdaq?
And this is how they do it. This is the secret sauce. Take a look at this table. The company has just been hammering the reverse stock split button. We're talking 8 of them since 2022. And look at those ratios. One of them was a 1 for 250 split. Think about that. For every 250 shares you owned, poof, you now have just 1.
And when you compound all of those splits together, you get this absolutely mind-boggling number. An investment in this company has been wiped out by more than a quadrillion to 1. I mean, that's a number so big it almost doesn't feel real.
But here's the kicker. While all this shareholder value was just evaporating, the CEO, he was doing just fine. Over $94 million in compensation. And get this, you want to know how much of his own skin he has in the game? A recent filing showed he owns, wait for it, a single share. Okay, so this whole thing feels pretty sketchy, right? But how is it even possible? To really get it, we need to break down the tool they're using, the reverse stock split. You've probably heard of a regular stock split, right? A company like Apple or Nvidia is doing great. The stock price gets a little pricey, so they split it. You get more shares, each one's cheaper. It's usually a good sign. Well, a reverse split is exactly what it sounds like. It's the opposite. The company literally takes shares away from you to artificially jack up the price of the ones that are left. Now, if you ask the company why they're doing this, they'll give you the official reason. And it's all about survival. See, exchanges like Nasdaq have rules. If your stock price drops below $1 a share for too long, you're out. You get delisted. So a reverse split is a quick, kind of brute force way to pump that price back over $1 and stay on the exchange.
But here's the thing. Staying listed, that's often just the start of the story. For a lot of these companies, a reverse split isn't really a life raft. It's a key piece in a game that can absolutely wreck regular investors.
And here's how that game is played. It's a vicious cycle. Step 1, the stock price sinks below $1. Step 2, they do a reverse split to pop the price back up. But then, and this is the crucial part, Step 3, they use that new higher price to issue a ton of new, heavily discounted shares to their financial backers. Step 4, those backers immediately dump those shares on the market for a quick profit. And all that selling, you guessed it, crashes the price right back down. And then the whole thing just repeats.
So what's the bottom line here? It's all about dilution. Every single time this cycle spins, the pie is being cut into more and more slices. The company gets a cash infusion to stay afloat, the financiers pocket their profits, and everyday shareholders, they're left with a slice that's getting microscopically smaller each time.
And look, you don't have to take my word for it. People on Wall Street see this happening. A top lawyer at a big market-making firm, Virtue Financial, wrote to the SEC about this. He called these companies classic penny stock companies and straight up linked them to pump and dump schemes and market manipulation. Pretty strong words. So, okay, what does this all mean for you? The big takeaway is that this isn't just one weird story about one struggling EV company. The Bollinger case is just a really extreme example of a trend that is absolutely exploding across the market right now.
I mean, just look at this chart. The numbers speak for themselves. On the Nasdaq, reverse splits went from just 31 back in 2021 to 464 in 2024. That is an insane jump. This isn't some rare, obscure maneuver anymore. It's going mainstream for companies that are on the ropes.
So how do you spot this and protect your own portfolio? Well, here are some huge red flags to watch out for. A company doing multiple reverse splits in a short period? Red flag. A company that's just constantly losing money? Red flag. A company that's always issuing new shares, watering down your stake? Big red flag. And maybe the biggest of all, executives who have almost no personal money invested in the company, like owning just a single share.
And that really brings us to the final simple question you should ask yourself anytime you see a company do this. If a business needs to use these kinds of financial tricks just to keep its head above water, is that really a business you want to own a piece of?